Hello everybody, welcome to Economica, and I'm very happy to be back with you. First of all, thanks a lot to all the viewers on my video. I hope you find the videos interesting and insightful, and basically that you could take some info or learn some concept, things that you didn't know. And yes, I'm back with you today. Just off of a higher than expected CPI and core inflation data coming out from the United States, and we see that we got core inflation. It was 3.3%, inflation was 3% year on year, CPI, and the same measures of core and CPI inflation have increased slightly on a month-on-month measure, and yes, these are basically headache problems for the Federal Reserve and monetary policy decision making. Luckily, I don't have anything to do with that, so I will leave to them what they have to do. So today we actually going to do some time series study and simulation of what can happen to the dollar index, because the dollar has been very strong for the past 3 or 4 years, for quite some time. I mean, and many people are stuck. They've been always questioning what is the role of the dollar. Is it still viable as a world reserve currency? Do we need another more flexible global monetary system? There are many questions that are basically posed every day, and yes, there's been a lot of academic discussion on the role of the dollar, etc. And yes, basically the role of the dollar is very important, and it's one of the factors for which the United States can consistently have an economy that runs on twin deficits, like balance of trade deficit and fiscal deficit. So the United States can basically inflate its money supply and offload a lot of its domestic debt to foreign investors, exactly because of the role of the dollar as a global currency for payments, for commodities, for any sorts of payment system, settlements of payments, cross-national transactions, all these sorts of things we know now. We have known this for many decades, and yes, we should not forget that Nixon decided to unpeg the dollar from the gold exchange rate. So now then we got since then we have a system of floating currencies, which is a very interesting market for traders. Yeah, of course, you see we have here the chart of the dollar index, or pound dollar, or euro dollar. Sorry about this, these are some indicators that I pull up from time to time. And yes, dollar Swissy, dollar CAD, and what else? Dollar yen. So some of the most major cross-pair currencies. And yes, as I was saying, what will be the role of the dollar going forward, and how, from a trading perspective, the dollar index would evolve or behave. What traders in the market, how traders in the market will price the dollar index. We will have a stronger dollar, a weaker dollar. So as usual, I've done a bunch of time series analysis with some volatility models, the usual ones, standard deviations, and all that kind of nice stuff. and we'll try to figure out these models, what are the results, what are the outcomes, and we'll try to basically understand what could be a reasonable or a theoretical, let's say not reasonable because markets are not very reasonable, theoretical approach to exchange rate or forex market trading, and just to see basically if we should be long dollar, short dollar, we should be long euro or long pound, or we should be I don't know, we should be short dollar yen, all these kind of things. And yeah, okay, so let's get on with it, and then I'll throw in some other stuff which are some macroeconomic data. And okay, let's start from the macroeconomic data. So, few basic things. The why the dollar is in a very dodgy situation. Because as all the other 192 countries in the world, the United States total federal debt, as we see here, official data, it's is on a ramp up. This is an quasi-exponential function, and as of Q3 2024, the total federal debt was $35.4 trillion, which is well above the 100% debt to GDP ratio. I think we are around 120. I don't know I can't be bothered with the exact number because it doesn't matter to me. But and this is a very large amount of debt that basically has been created by inflating the money supply. So we know that more and more money is created in the economy, then the result is that inflation is not stable at 2% as the central banks they try to sell us for full, and then inflation is going up again, and that keeps ballooning up. You are inflating that, and the value, the purchasing power of the domestic currency keeps going down, keeps decreasing. So there is a huge underpinning issue of currency stability and the currency domestic purchasing power. And if inflation goes basically totally out of control, there are countries, and very famous example in the history of economics is of hyperinflation. So as we see here, the federal debt was around 35.5 trillion. I think will be more now. I don't care. And yeah, the overall all sectors debt, securities and loans liabilities level is 101.3 trillion, my dears. So it's well north of $100 trillion of all kinds of debt securities. Government debt, mortgage-backed securities, loans, corporate debt, household debt, whatever you want to throw into this basket, we are north of $100 trillion of debt. And debt levels or liability levels, yeah, we have to be careful, make a distinction between the debt level, the liability level, because the liability level is supposed to have an asset level. So that's all to see. But anyway, this is a humongous amount, 100 trillion, and I don't mind about the amount and the zeros. The problem for everybody else in the world, for the 192 countries in the world, is the dollar. So I mean, all this debt, this huge amount of debt, is denominated in dollars. Okay, and yeah, so the basic issue is that the dollar, the purchasing power of dollar has been decreasing across time very deeply. And so if any investor is holding assets which are financial assets, which are denominated in dollars, debt that is denominated in dollars, or basically dollar deposits, I think they should be thinking carefully about keeping those assets in dollar, or maybe trying to find any sort of diversification. I don't know what they would choose to do, gold, silver. I'm not here to suggest what people have to do, but I only make a clear I only give a hint or make a clear assessment of the situation, and we have north of 100 trillion of liabilities level only for the United States, which is denominated in dollars, and I would not be very quiet and relaxed in being exposed to such a currency which has such large amounts of insolvable liabilities. So because there is a serious danger that basically the currency can lose value a lot. And for example, if we go back to from the year 2000 to 2008, when basically with the Greenspan put, even after the dot-com bubble, the United States economy has been inflating debt and creating a bubble, an asset bubble in the housing market. We see that the dollar index went from 120 in 2001, late 2001, to the bottom of 70. Basically, Wall Street broke the back, and so we have a constant downsloping trend for the dollar index chart. That means that basically the value, all the intrinsic value of the debt that was issued was basically nothing. It was shredded paper. And so if we know that the overall level of liabilities outstanding for all sectors and of the economy and all kind of liabilities it's $101 trillion, and I would basically start to question what is the dollar worth? What is or is it worth to have assets denominated in dollars, or basically is it safer or it's clever to start to find other assets, or assets are denominated in other currencies, or diversify with gold, or even larger things like other payment systems. There are many machinations that anybody can try to figure out, but if you are a trader or you are an investor, I think you should be not overly concerned, but be aware that the liabilities levels which are denominated in dollar are huge, also for the United States' domestic economy, and I'm not so sure that the dollar would be the privileged or the reserve currency of the world. It cannot keep this status for so long if and when a very large debt crisis or financial crisis can materialize in the United States. And yes, just 1 second, because I want to show you basically the argument that that has been thrown around is that the rest of the world has liabilities in dollars, and so the dollar will strengthen because everybody needs dollars to pay off its liabilities, but you can hedge and fund yourself in euros and then pay your liabilities in dollars, and if the value of the dollar goes down, then it's way cheaper to borrow in another currency and then pay off a shredded paper, which is debt denominated in dollars. And as I was saying, there is an idiosyncratic problem within the United States economy, because on the New York Fed website we see that the overall household debt it's around near $18 trillion, and it's well above the 2008 financial crisis peak of a little bit more than $12 trillion. So we saw a little deleverage, and then we've seen an enlarging and engorging and indulging in more and more debt issuance also for the households, just for the household balance sheet alone, which can be mortgages or I don't know, car leases, credit cards, consumer loans. So consumers have been at it borrowing and borrowing and borrowing, and the value of the dollar keep decreasing, and the value of debt keeps inflating at same pace as assets keep inflating. Now this is very easy. If house prices were $200,000 and then now the median house price is $2 million, the attached liability to buy a house for $2 million would be, I don't know, $1.8 million. So for the same house I'm paying 10 times the amount that I was paying, I don't know, 30 years ago. This is symptomatic of, this is explicative of a total loss of purchasing power of the domestic currency, a inflation in asset prices that brings along an inflation in debt. So that's debt that keep piling up. And at some point, I think we are well past the event horizon of the ability for the American consumer and the United States government to pay back its debt or all its liabilities, as is for all the other countries in the world, more or less. The United States can pay its debt, but I don't think they will choose to do so. So, considering all of these basic data that we can see, basic charts of very high levels of debt, and here we see here the title: delinquency rates remain elevated on a nearly 18 trillion household total debt balance. So I start to say, okay, let's go and check what to do with the dollar index. And yes, so for example, if we can try to see what is a Bollinger Band. Yeah, okay, the Bollinger Band. If you are a trader, for example, you start to check out what the Bollinger Band is doing. You see that the trend here is after the 3 green candles. I think this I know what is the pattern, but basically 3 white soldiers, something like that. We have a doji that's basically market is undecided, it's just hinging around here, pinching the Bollinger Band, and then we have another. This is on a monthly time frame. We see that we have another doji. We have a lot of trading prices around here, around this level, 108, 185, and probably this could be a if we interpret or we want to take for good the Bollinger Band technical signal, this could be a trend reversal, and then we'll have to wait for another big red candle that can confirm the fact that the dollar index is started to be priced on a downside on a much lower level because of many other macroeconomic factors in the economy, or any other variable that has to be considered in order to take this decision. Yeah, this is for example the Bollinger Band. Let's see another one that I like a lot. It's the Ichimoku cloud. Yeah, okay, so we see that as long as this trend line is above the Senko span, still is uptrend, but we have the brownish line. It's just small signal crossing the blue line. I don't remember exactly the Japanese words for this. I apologize, but I don't do much of technical analysis because it's to me it's kind of a waste of time. Sorry about that. But anyway, for example, we would say, okay, the dollar has gone up here, we are testing some sort of market pricing resistance level, which is around this area. Yeah, let's say here 109, something like that. And then, for example, we could have a small retracement of the price of the trend line from 108 to 105, just on top of the pops, on top of this shaded area here, just around here. 20 pixels. Yeah, and then some sort of downtrend going here, and then basically the Ichimoku indicator, it works this way. Once the trend line is broken through the Senku, the span, which is a lagged indicator, it's a forward looking cloud span. Once the trend has gone through this area, this shaded area, green shaded area, then it's a confirmation, technical signal confirmation of downtrend. And yeah, so it's here. For example, we see it's here, then it goes through this shaded area, and then it breaks through, and then it tells you this basically is a technical signal to explain, oh, we are going down for a long time, we're going to have a downtrend for a certain period, which is many months in this case. So I don't know what the dollar is gonna do in the next 2-3 months or 10 months or whatever is the time. I was trying to cancel this brush, but I will find some what to do. Okay, yeah, just cancel it. Get rid of all this. But I was saying, I don't know what the dollar is gonna do, and so I only have to consider what are the macroeconomic data or the volatility data or the option market to have a more precise picture of how investors are betting or positioning or basically betting on the direction of the dollar, or what investors think what is the right level of the dollar in the market vis-a-vis other currencies. So now let's go to our modeling, and yes, so I started with the normal standard deviation and things like that, but I decided to I want to show you now first the results from a Bayesian linear regression, which I think they are very interesting, and they can give us some idea. Since the baseline exchange rate is the Bayesian model extrapolates, and yes, we have some interesting parameters here. The baseline exchange rate for euro dollar is 155, or for the pound is 2.06, and I mean the charts, they reflect what is the historical trend of the exchange rate, and yes, the shaded area is the credible interval, the red straight line is the mean prediction, the observed data, and yeah, we have here the Gaussian curve for the alpha parameter, the beta parameter, and the sigma parameter, and we have here what are the most the high density interval values. And yes, basically the alpha parameter is the baseline intercept. It's the same criteria as a linear regression, and the beta parameter is the slope, and the sigma parameter is the volatility component of the linear regression. And yes, so withstanding the historical trend, we see that the Bayesian linear regression takes as a baseline alpha parameter, which can be traced to the exchange rate at a very high level for the euro or the pound, and yes, also for the Aussie dollar, one well above parity, and also for the dollar Japanese yen, we have an exchange rate between 74 is the high density value, but these are the high density interval, and for the alpha parameter. While instead we see that today exchange rate it's 150, or it's well double what is the alpha parameter for this Bayesian regression, which is it's a time series simulation. It's a model applied to time series and gives you a simulation according to past data, but we start to have some hints of some data which are not aligned with what are the day-to-day market data we are traders are seeing now. So I don't know, should we take it for very reliable model, or we should basically throw it in the bin? I don't mind. I run some model simulation and I see what is the outcome, and I just take with me the data, and I basically build an idea on what the models give me, which is not an exact science, but nevertheless it's a way for me to observe what are the market behavior, market patterns. So yes, see here dollar CAD 0.87. So these are very different exchange rate levels for the alpha parameter than what are now in the market. And just for clarity, the Bayesian regression works. We have a y which responds to alpha plus a beta parameter, and then we have some sort of variable here, and which is multiplied by x plus a epsilon, which is a noise value. And this is a classical linear regression. We have the intercept value, which is this one, and the beta parameter, which is the slope, or the slope of the regression. So this is the basic stuff that it's very easy to read. Some quick tests for stationarity. We see that all the p-values, so the time series, the data have been worked with the first different residuals, all that kind of stuff. And I worked first with some Garch and E-Garch model, but some were not totally robust, and there was not full convergence for the data. And for the conditional volatility that was extrapolated from the data. So let's go down quickly. So I decided basically go back and check all the residuals, and we see here classic quantile on quantile plot of residual distribution, and we have the usual extreme values which are very far from the normal regression. These are the usual fat tail values. For example, euro dollar we have a minus 10%, cable pound dollar minus 8%, stuff like that. And then here we have the usual clustering of residuals, and usual time series analysis for checking what are the first reference and residuals on the data. And then it gets more interesting because I start to process some additional features for the conditional volatility models, and we can start to see something funny. So as we know that the E-Garch model, these are usually they are a better fit than the Garch model, because the equation that works for the eGarch model is made in a way to calculate within the time series what are the asymmetric shock in the conditional variance or conditional volatility of the data, while the Garch model is the basic model which only calculates the conditional volatility, conditional variance, without going further in calculating the asymmetry of volatility shocks. So we see here, for example, that in fact the news impact curve for euro dollar has a much higher rate of change in conditional volatility for the Garch model than compared to the blue line, which is the Garch model, which is quite normal. Okay, and here we have the density of the residual distribution, which is more or less standard procedure, and these are the first chart of conditional volatility for euro dollar, and we have a slight uptick in conditional vol for Garch and eGarch model, and we have also here a CDF function that captures the Garch and eGarch data compared to the standard normal CDF function, and we see that the residual minus 2.5, 0.2.5, this is exactly that's here, but these are distributed in a cumulative way, and according to the cumulative probability of having certain data, and we see that we have 0.6 cumulative probability of having 0, or very high probability that we have above 0, like 1 unit in residual, or very high probability that we have 2.5 in standard residual. So this is how to more or less interpret the chart. What are the residual is the residual error of the conditional vol. So what is the residual error in the conditional volatility, which is basically the volatility based on past square returns and past variance. Okay. What I was saying is that, for example, if we go and see the cable, we see that, for example, the Garch model for the news impact curve, which is basically how exogenous factors like market announcement, fiscal announcements, or monetary policy, or anything in between. So we see that we have a higher conditional vol captured from the Garch model rather than the eGarch model. So this is an interesting feature that basically shows us an inversion of sensitivity between the Garch and eGarch model. Capturing what is the conditional variance, and here as well we see that in the graph we are having a higher volatility moment, like clustering, that tends to go to the upside, and then maybe we can have a spike again in a conditional volatility, which will mean that the value of the pound will go down compared to the dollar. So these very high volatility peaks and spikes, they happen basically, they are the expression, the visual expression of what are the financial crisis. Let's call it financial crisis, of very large market moves, and very large volatility, and very large day by day price oscillation and changes, and these are very interesting. These peaks, there are some sort of points on non-derivative. There are no derivatives. There is no derivative that will save you at these points here. It's very complicated stuff. But anyway, you can, I'm saying there are no derivatives because there are no option that can save you in this kind of very high volatile environment. Yes, and again we have CDF function, but again Exogenous factor, news impact curve, dollar yen, the EGACH model gives us a very high conditional vol that comes out from exogenous factor rather than the GACH model. And they are all symmetric to zero. If we have a shock of plus or minus 2 or plus or minus 4 units, we see how the conditional volatility can vary by 1, 2 units and more. And yeah, we have some very contained dollar yen vol, which probably will not be the case going forward. And again, for Aussie dollar, American dollar, we see that the GACH model gives us a larger conditional vol for any exogenous market announcement compared to the EGACH model. Also dollar CAD, dollar loonie, we have a GACH model that captures better what are the exogenous factors of the news impact curve on the volatility of dollar CAD compared to EGACH model. And yeah, for dollar CAD we have standard residuals which are plus or minus 4, so it's quite large distribution. It's not plus or minus 2 for as was in or 2.5 as was in euro dollar. So we have a quite larger fat tail distribution even in the residuals of data, of the time series data, residuals of the returns, square returns of dollar CAD. And we don't have a news impact curve for dollar Swissy, I don't care. And yeah, dollar index, we see that yeah, again the GACH model, oh that's nice. The GACH model captures better the exogenous factors that can create some higher conditional vol compared to the EGACH model. So asymmetry or not asymmetry, the GACH model does a better job. And the CDS function, we see that we have parameters here that are as large as plus or minus 5 or plus or minus 4. So. And we have here, we see that we have some clustering. The volatility smile, you are on candid camera, very smiley. And yeah, probably we can have a huge spiking vol for the dollar index, which will be very, very nice for traders. At least a bit of excitement for this. Oh, okay, sorry, this was dollar Swissy, forget about it. What I said about this CDF function. This is the dollar index CDF function, and yes, well, we still are in a large residual distribution, plus or minus 4. And yeah, this is the volatility smile, and for dollar index, and yeah, we can see that we are having some clustering of vol. Let me check out the smile for a second. Hope you're smiling and laughing with me. And yeah, this is a sort of technical analysis, like a double bottom pattern. And double bottom, if it breaks out from this level, we're going to have a lot of fun. And yes, we're going to have a lot of fun, and yeah, we can smile again, very smiley. If we break the double bottom, just breaks up, and we have higher volatility. So then I implemented some more models, expanded the GACH model family, and yes, we have 4 GACH models: GACH, EGACH, TGACH, APACH. And yeah, let's start to check the charts here. Buzzer, and yeah, we are having. I apologize, I don't have a scale here which is decimal. I should have thought about that before. But anyway, we can extrapolate that we are having a lull and a dull and a convex curve shape that could bring us to 1 unit of conditional vol and high volatility in euro dollar, and it would be very nice to have some more volatility in the dollar index, and to have some market moving factor that will make possible for traders to make money. the end of the day, we are all here to make money. And as we saw before, we have the decimal scale, and yes, we are here, and if we break up here, we're going to have higher vol also for dollar, pound dollar cable. And I think we can assume we are on these levels. We are between 0.5 0.75 conditional vol, also for dollar yen. And dollar CAD, we are having a lot of volatility. Not a lot, but we are at the same levels as the other currencies, more or less. I think it's a little bit, dollar CAD is a little bit more volatile, so probably this would be, it's worth paying attention here. Attention please, because we are approaching this level, and if I ever break through this level of high vol, it's going to be very, very fun for traders who want to be long dollar or short dollar against Canadian dollar. But nonetheless, there is higher volatility clustering. And let's check it out. Yes, as we saw before, dollar index also picking up in vol clustering. Are exactly the same chart as before. And I managed to have a very nice correlation heat map chart for the conditional volatility, which is nice to have, a nice to have thing, but we can go and check the data. And the average conditional vol for euro dollar is 0.62 correlation, and 0.57, 66 is very high correlation with Australian dollar, US dollar, and somewhat of good correlation with dollar Swiss. These are the standard deviation values, which are not negligible. Conditional vol, so some sort of vol of vol, volatility. And we have here the various ranges, or 25, 50, 75. These are very, very interesting, and the heat map basically tells us the more reddish the color, it's the higher is the correlation between conditional volatility. And this is a dollar yen has a higher correlation in conditional volatility with euro dollar, and one instead it has a less of a correlation with pound dollar. And so here we have an interesting correlation with Aussie dollar and dollar CAD. So these are interesting data to have on a more precise scale, just to, if you want to place more than a bet and say, okay, if euro dollar vol is going up, maybe I want to place a bet also on Aussie dollar, US dollar, and on dollar yen, and see how I can profit from the market. The currency's volatility. These are the exact values of the conditional volatility for the correlation heat map. And euro dollar and pound dollar have 0.83, which is not a negligible value, it's a very high value, 0.83, and which basically says that a 1 unit change in euro dollar conditional volatility will explain an 83% or 0.83 unit change in correlation of the conditional volatility for dollar Japanese yen. So it's a very high correlation, and similar is for Australian dollar, US dollar, dollar CAD. A little bit less for 0.52, so it's a bit of a 50-50 thing. And of course, 76 or 76%, let's say, of correlation between euro dollar and the dollar index itself. And if we see the column of cable, we have a less of a correlation with euro dollar, but more of a correlation with the dollar index, of course, and with Aussie dollar and dollar loonie. So these are different dynamics that are at play for cable. Yes, yeah, dollar yen is very much correlated with euro dollar. Okay. And okay, so if I want to place a bet, let's do the game. Let's play this game. Okay, let's do like a short recap. If I have a euro dollar, I would place a bet on dollar yen, which are correlated, and also Aussie dollar. I think you understand me. Aussie dollar, AUD, USD, right? Yeah, and also on dollar uni, on dollar loonies and the orange in the nut house. And yeah, instead, if I'm trading cable, whatever it is, the cable, I cannot write cable. If I'm trading cable, I want to place a bet on dollar loonie. So dollar CAD, it's more correlated with sorry, I'm messing around. Dollar. Okay, so forth and so on. So if I would have to make a quick like a scheme or a short table, I would know that if pound dollar is getting more volatile, maybe I would have to check out if Australian dollar and Canadian dollar also are volatile, and then I would place a bet on these three currency pair according to what is the market direction. And when instead dollar yen is very correlated to euro dollar, so these two currency pairs I would trade it together. Okay, I would check what is volatility on dollar yen and then what is volatility on euro dollar to see if I can find some profitable trading setup. Like Australian dollar is correlated also to euro dollar, so I would check euro dollar if the Aussie dollar is volatile, and also also all the other currencies, and I will check especially dollar Canadian dollar CAD, if Aussie dollar is volatile. And yeah, so forth and so on. More or less, dollar Swissy, it doesn't come up with a very high correlation, but remember, this is conditional volatility. This is not the correlation of returns of what happened, what are the percentage changes in the market, but it's the conditional volatility, so it's another thing. And yeah, so more or less, euro dollar very correlated to dollar yen, on Aussie dollar or the Canadian dollar, or the pound, it's only correlated to the Aussie dollar and Canadian dollar. And so anytime you're trading, you can take with you this table, take a screenshot, and see you have a very nice table which tells you what is the conditional volatility. The correlation of conditional volatility for these currencies, and I will have basically provided you with a very useful tool. Okay, so we can go quickly through the results of the Gauge models, and we start from euro dollar. And yeah, all these parameters, they are all good. Log likelihood, the AIC and BIC criteria, they are all good, so the model fits very well. And yeah, the p-values for the alpha and beta parameter, they are statistically significant, so we can take the parameters for good. Let's take it for good. And yeah, the alpha parameter, so the measure of how past shocks in conditional variance are a determinant factor for the future shock of conditional vol. It's 0.05, so like a 5%, 5.2%, while the beta parameter tells us, okay, the persistence of these shocks is very high, it's 0.94 or 0.95%, and it tells us that so what are past shocks or conditional variance volatility shock on in euro dollar are persistent or static. And yeah, we have the mu coefficient, this is the baseline variance, which is a very small coefficient. Yeah, okay, so going forward we have here, yeah, the EGARCH model does the same, and we see that the log likelihood is slightly better for the GARCH model than the EGARCH model, but still it's a model that fits properly, it's robust in its outcomes, and the baseline variance is statistically significant for the GARCH model, so we start to capture more and then the omega parameter is not statistically significant, so we can avoid to consider this one, and the usual alpha and beta parameters. So we see that the past shock volatility for the GARCH model is much higher, it's 14%. So past shocks tend to generate a 14% conditional volatility for euro dollar. GARCH model, guys. Okay, these are the alpha. The beta parameter is there. Sorry, that's what I was looking for. The beta parameter is very, very high, so it's almost fully. There is a lot of persistency according to the EGARCH model in conditional volatility in the euro dollar. EGARCH again? No, this is TGARCH, sorry, that's why. TGARCH model. So, for the TGARCH in APARCH model, we have another parameter, which is the gamma parameter. So, the APARCH model gives us the gamma and the delta parameter, which are also important. And of course, they give us additional information about the conditional volatility within the time series, the data that we are working with. So for the gamma parameter, we are basically in the TGARCH model. Basically, the gamma parameter is useful to calculate the asymmetric impact of negative shocks. So if the gamma parameter is negative, what will tell us is that the asymmetry in the shock. So if the gamma parameter is negative, it means that negative shocks have more effect on the conditional volatility rather than positive shocks, okay, because the parameter is negative. While instead the delta parameter basically would measure the difference between the asymmetric volatility parameters. Okay, so let's see what euro dollar gives us in as a result, and we have again the alpha parameter is the same 14%, the gamma parameter is a negative parameter, but we see that the p-value is not statistically significant, so we can just don't consider the gamma parameter, and the beta parameter is 1, so there is full persistency of conditional vol for euro dollar. And yeah, here for example the APARCH model gives us a smaller alpha parameter, which is more 4.9%, 4.97%, almost 5% rather than 14%, and also the beta parameter is a bit less, also still is a very high parameter. And we have gamma parameter. It tells us the asymmetry is more pronounced for positive shocks, but still here the p-value is not statistically significant. So we can this p-value is significant, so we can take for we can consider the gamma parameter in the up arch model. Okay, and so it does for all the other cross-currency pairs. And basically what we can extrapolate more or less, with accuracy, with precision, is that the alpha and beta parameter, the most simple parameters, they tell us that the past shocks or conditional vol for dollar, for pound dollar, and for let's see here, dollar yen. What are the parameters? Here we have up arch model. The alpha parameter is 0.78, almost 8%, and the beta parameter is 92%. So we have past shocks of conditional volatility explain 8% of conditional volatility in the following periods, while the beta parameters, in this case for dollar yen, in the up arch model, up arch 1-1 model, tells you that the 92% persistency of conditional volatility for the dollar yen exchange rate. Okay, and these are all the parameters that are idiosyncratic for specific for each currency. So we see that, for example, the basic EGARCH model tells us that for cable pound dollar we have a 98% persistency in volatility shocks, conditional volatility shocks, within the time series of past square return and past condition variance on the following periods of conditional volatility. And also the alpha parameters tells us that almost 15% of past shocks are a determinant factor for following up periods of conditional volatility, which are not negligible. And the EGARCH here for dollar yen gives us a very high alpha parameter, 0.16, and a very high beta parameter. So we see that let's say the simplest concept to understand is that conditional volatility, it's a parameter within a time series of data that tends to be persistent, and to basically what are the previous patterns of data of conditional volatility, they are reflected in following periods. That's why the study of volatility, it's very insightful to understand what could be going forward, how the market could behave in terms of pricing a financial asset or an exchange rate. So if we are going to have more volatility, then we can try to find a trading setup opportunity if we manage to understand a little bit before time how the market is going to move. So if we have higher volatility, we want to go long pound and short dollar, or we want to short dollar and go long yen, or we can do the opposite. Here, for example, we have high volatility for dollar CAD, and let's try to see what the chart is doing on dollar CAD. We are having here, let's do this comparison, because on this website I don't have any, there are no data for conditional vol and that kind of stuff. So what is going on with dollar loonie, US dollar Canadian? We are here and we see that the market has tested again for the third time this level, which is 146 change. Okay, so we have a 2016, February 2016, which is exactly the same period as now, and March, exactly same March 2020, and here February and March 2025. So we see that exactly at the same period of time we are having here, and here. If anybody who is still listening to this video, you see that exactly the same period of time between February and March 2016, February and March in 2020, and February and March 2025, the market has tested exactly the same exchange rate level, and we are having exactly the same volatility pattern. So we have a market reversal, trend reversal, and the dollar is going down, and on the other side the Canadian dollar is gaining value. And this is of course is very much correlated with what happens with the conditional vol. Okay, so this increase in conditional volatility, it's basically we are here, somewhat around these levels compared to 2020. Let's go back. Here in 2016, we had a peak in vol, which is here. And if we go on the chart, you see that here we have this peak of volatility, same exchange rate level, 146, 147. So the market behaves exactly the same over and over again across time. That's why conditional variance is based on the past square returns and past conditional volatility. It tells you how going forward volatility is going to behave, and then you can apply the volatility to the price action and see, okay, if volatility is going up, I presume I want to be so arrogant to presume that maybe we have some sort of market behavior of this kind. Okay, so that the higher volatility, the dollar will go down compared to the dollar will depreciate vis-a-vis the Canadian dollar. So the conditional volatility is a tool, important tool that any trader can, together with option chain volatility, can utilize to place bets in the market. So you see here, same period, we are having a trend reversal. So if we want to play around this stuff, basically we have a 20 from 147 to 120, we have a 27 cents change, which is a very big move for currencies. For currencies. And here we see that we have a very big signal in the RSI, which is pointing down, and this will go down quite a lot. So there could be a downtrend for the dollar for quite some time, for months to come. And nevertheless, remember that there is always a lot of chop and change, so you can do up and down here, and then it goes down. So there are a lot of market don't move in a straight line. And yeah, here we see that we have peaks of vol in 2020 and also 2016, which is high, so we can expect higher volatility, and eventually this dollar CAD to move down more than it is now. So it could go down, I don't know, to this level, which is 140, which is already a big move from 147. So this is our all very interesting features. Yeah, for dollars we see, if we go back to our Garch models, we see that also the alpha and beta parameter of path shocks and the persistence and volatility are all significant. They are all statistically significant. The p-values are statistically significant. So again, conditional volatility is an important tool to navigate markets and to foresee additional volatility going forward. And this is the chart of dollar index, and yeah, the Garch model, we have almost 10% in the alpha parameter, 0.99, so we have a lot of persistency, conditional vol. And let's go and see what are so the gamma parameter for the T-Garch model, very statistically significant. So yeah, the beta parameter here is significant. The delta parameter for the Aperch model is significant. It's a very large delta number. Okay, so Going back to more humane data, here we see what are the average values for the 7-day and 21 days annualized standard deviation. So euro dollar talking about 11.2% in the short-term volatility, 8.6% in 21 days volatility, and these are nice volatility parameters, are not very small, north of 10% for each currency pair. And again, we see a pattern here, we see a volatility pattern. Dollar CAD is more volatile. 7-day annualized vol is 17.5%, while the 21 days is 11%. So 21 days annualized standard deviation of dollar CAD, it's similar to a 7-day vol of euro dollar or pound dollar or dollar yen and Aussie dollar, while dollar Swiss franc is more quiet, and dollar index it's quieter, of course, because it's dollar index, so there is no other currency that is in play. And yes, these are the charts for the standard analyzed standard volatility, standard deviation. And an additional measure together with the annualized standard deviation on 7 and 21 days, what is the 30 days moving average price for euro dollars. In the past 30 days we are around 1.035, pound dollar 1.2388, dollar yen 1.56.2, 0.62 for Aussie dollar, dollar CAD 1.43 is the average exchange rate. If you can check back again this chart, we saw that we have 3 times the same pattern. It's been repeating, and the average, the 30-day rolling mean exchange rate has been reached. We are at 142.68, so we can presume, for example, that dollar CAD could go down further, like in this kind of pattern, but nevertheless this is a very interesting market signal to consider for trading dollar CAD. And so it's a interesting table to have with the annualized standard deviation and what is the past 30-day average price for the exchange rate, the past 30-day exchange rate level. And then I did a lot of I computed basically the VAR violation. You see that cable and dollar yen had the most VAR 99.9 days with 19 and 11 days for so very large 1-day loss. And I asked the machine to produce some other charts with the VAR days. I'll have to go quicker, and also I asked the machine to do a seasonal decomposition of volatilities, just to visualize what is the vol, the trend component, the seasonal component, and the residual vol for each time series. I managed also to add some VAR 95. The red dots are the VAR 95 only violation, overlapped on the volatility trend. And so this is useful to see how many times the VAR 95 is being violated across time in basically alignment or in correspondence with the higher volatility in market, according to also to seasonality or seasonal decomposition components. So these are very useful charts to have. I want to go forward because I've calculated a lot of things. So I asked the machine to do a simulation, chart simulation of basically what happens to the exchange rates if the dollar index goes down by 10% or goes down by 20%. And here we have the charts. and we see here the green line is the euro-dollar exchange rate with a 20% depreciation of the dollar index, and we are north of 120 as euro-dollar exchange rate. Compared to the market today, it's pricing 104, so 20% dollar index going down will bring euro-dollar to 1.2 handle and change, so it's a very big move, 16 cents or more appreciation of the euro against the dollar, while the red line is the 10% depreciation of dollar index, and we are at 115 level, so still it's a 10 cents move higher, so it's it would be a still are sizable moves if you want to place a bet and say, okay, euro will go up and the pound will go up, and so let's place this bet and hope that the dollar index goes down depreciates by 10 or 20%, which is not unfeasible. It depends on many factors and also how the market wants to price the exchange rate. Here we have opposite this is the actual exchange rate dollar, the US dollar, Canadian dollar. So if the dollar goes down, we are at 140.42 today, so a 10% depreciation will mean a 130.32 exchange rate, and here we are around 1.2. So this would be very nice, because if, for example, dollar index depreciate by 20%, we will have euro dollar around 1.2, 1.22, 1.23, okay? And on the other side, we'll have a dollar, Canadian dollar, around the same levels, around the same level of exchange rate, with the 20% scenario of dollar index depreciation. So these are exchange rate level equilibrium that will change, and also I don't think I don't want to say they create an arbitrage opportunity, but for sure there will this chart display a different level of equilibria between currencies, exchange rates. That will also generate a different kind of flows or capital flows between financial markets. 1 second, the Mickey Mouse is frozen. Come on, Mickey Mouse. Oh, it doesn't want to work. The batteries are down. I'm wasting my time with this. Come on, Mickey Mouse. Yeah, okay, so saying capital flows and other equilibria in exchange rate levels. So here we have the simulation for the scenario of 10% dollar index, 20% dollar index depreciation in the dollar yen, and here we have a 140 more or less, 130, 140 exchange rate, and here, I should have plotted this chart better. This is 130, 140, 130 exchange rate level, which is a very big move. And yeah, also the Australian dollar will appreciate a lot, almost towards parity, or 0.70 or 0.80. Appreciation in the exchange rate market. And yeah, so last but not least, when we calculate the VAR days, we want to know what happens if the market basically goes through my VAR parameter, it breaks up my VAR parameter, and the market goes down more than what was my parameter. And then so we have this EVT, extreme value theory, together with the Pareto distribution, that explains us what are the heavy tail distribution of excess returns, of excess volatility markets, and gives us an additional parameter, which is ES, which is not the S&P, but is the expected shortfall. So euro dollar is a VAR 95 of 0.91%. Okay, so let's say the market goes larger than that, and then we have an expected shortfall, which is 0.66. Okay, so we have a a more precise measure of some additional volatility that comes into the market that we have not foreseen for. So for example, VAR 99.9, it's 4.2% down, minus 4.2% euro dollar. And then we have another expected shortfall of another 4%. These are very extreme, heavy tail values which I've never seen in markets, but nevertheless, these are useful to parameterize what are the volatility and the fat tail of higher conditional vol. Let's make a VAR 99, it's 1.6%. It's very easy algebra. 1.6%. The expected shortfall is 1.3%. So in total will give you 2.9%, minus 2.9% move in one day for euro dollar. Okay, so I know that I have a VAR 99 that it's just we blow through the 1.6% VAR 99, but I know that my VAR 99.9 is minus 4.2%. So in between minus 1.6 and minus 1.2, there is minus 2.9, which is the VAR 99 plus the expected shortfall. So I have an additional parameter that can help me basically understand what's going on in markets when volatility goes higher and breaches some of the parameters that I have set for risk management or for trading management, etc., etc. And yeah, so the shape parameter, this epsilon parameter, it's exactly what explains what is the tail behavior of the excess return distribution. So when the epsilon parameter is larger than 0, we know that the excess return distribution in euro dollar, as in all the other currencies exchange rate, it manifests, it has some heavy tail large price movements, fat tail events. Okay, and the sigma parameter or the scale parameter, it's basically defines what is the spread or the variability of the excess return threshold for or excess volatility threshold when we are talking about the VAR parameter or the expected shortfall. So this is a moderate variability of 0.29%. Okay, so very large, but still it's useful to understand, put together the parameters and have a picture which is here the excess return with the Pareto distribution, fits the curve, fits the excess returns, and yeah, of course here the method utilized is a peak over pot, which is not pot like weed. don't do it. It's a peak over threshold method. Okay, and yeah, this is very useful because with this model we can estimate what are the VAR parameters and what we can expect to be the shortfall, the excess volatility when we are encountering a fat tail event or fat tail extreme volatility, excess volatility in one day of business. And we see here sorry, frozen again. So these are the parameters for pound dollar, and the VAR 99, the expected volatility for VAR 99 is 3.5 and 3.9, so we are talking about a 7.5% minus 7.5% move. There is a 0.1% probability that this happens in one day for pound dollar. No, sorry. Analyzing after attention report. Summary of this is the summary of the levels. Yeah, this is the same. Yes, sorry, I was confused for no reason. Got the same exact data, they are precisely the same. So dollar yen, this is a very interesting because we see that the VAR 99 is very large, minus 4.7%, 199.9. So dollar yen is a currency that I would actually trade, because I see here that the 3-month chart, here we have a pattern that could develop in a downtrend, going down in this way. It's continuing down towards 1.43. Today we are at 1.54, so it's more or less it's a 10 cents or 10 yen move down. 10 yen, so 10 cents, 10 yen. And let's see the monthly chart. Yeah, so there is some sort of kind of head and shoulder somewhat, or something like that. People who like to play around with these things, I don't really fancy playing with charts on this kind of like technical analysis, things like that. But we see that we hit a Fibonacci level here, and we have another Fibonacci level here. So if we play the ping pong, we could say, okay, we're going straight down to 143. And also here the RSI gives us a direction, some sort of I hate this thing, there are so many options. The direction this way, they're just going down. The RSI, it's 57 point, so when it goes below 50, we know that there is a weakness in the trend, and so it's clearer that the exchange rate will go down. There is dollar depreciation in action. Yeah, with the Ichimoku cloud we can see here very well how the market maybe wants to move to this area here, and we will test the support here, or it will move down much more to 130, which is in line with the 10% depreciation of dollar index. Let's measure more or less what is a 10% move price change. 10%, yeah, will be around these levels. 97, of course, so we will go here. We will go and test this this diagonal line, which I don't know what importance have, but 10% move, it would be from 107 to 97 more or less. And so dollar yen will go to 143 or 130, depends what the market will price. But I sense that there could be momentum going forward for a dollar depreciation. So if we want to simulate some pattern, candlestick, choppy trade movement, or something like that. Anyway, thanks a lot for watching the video. If you like the video, please thumbs up, leave a like, leave a comment, type down a comment if you want to see more. I will do more research on the dollar, and next time around I will check more carefully what are the macroeconomic variables vis-a-vis the dollar, and see if there are actually more data available that will tell us if the dollar will go up or down. So have a good day, enjoy your week, enjoy your workplace, have a wonderful life. Let's hope for peace in the world, and see you soon. Thanks a lot. Bye bye.